Hello, Baker Investment students. Hope everybody had a great weekend. It's Sunday, September 26th, and we're going to be like 90 degrees outside in Kansas City today, so it doesn't quite feel like fall yet, but hopefully we will get a turn soon. I think about Tuesday, Wednesday it will start to change. So anyway, I can't believe we're already in start of week 3. So again, these courses move so quickly. Just stay on top of things. Of course, this week, continue with weekly portfolio discussion. Make sure to follow the prompt too. Address what it's asking for. So look at that. You'll have another homework. This week you have your first quiz covering chapters 1 to 4. So just make sure to get yourself in a space with reduced distraction, enough time to have the ability to take the exam without interruptions, have your book and everything available. And take notes too, because some of the quantitative problems you're going to see again in different form with our final exam. So with that, this week you're going to read about chapters 5 and 6. And just a little bit with just before that with the weekly portfolio, I want to just add it. I update mine out there every week. I just put in week 3. What helped save me a little bit was some of the dividends that I received from some of the energy stocks. But as we all saw, like last week was a little rough, and it's going to be interesting to see what's going to happen this week, especially with the debt ceiling. But it was a little bit positive news towards the end as the markets rebounded a little bit. But every week it changes, so it's just really interesting how news and information or what factors outside the control of the company can influence the price of that company's stock. So keep doing that. You're doing a good job of it. It's really interesting to hear about your post and all those things. So with this week 3, chapter 5, you're going to read a lot about portfolio returns and standard deviation. And again, that idea like a standard deviation, you're taking some observation like a return in a given year minus the average of those returns over a period of time. And you're going to look at that from a portfolio weighted perspective. But again, the idea of standard deviation is a measure of risk. So the greater the standard deviation, the greater the risk. So a lot of what this chapter discusses is the ability to look at standard deviation and also the idea of correlation. So basically, correlation is a number between -1 and +1. Mathematically, you actually have to calculate covariance first and do some mathematical manipulation. You can get it between a number of -1 and +1. And thinking about my recent dissertation work, we look at things statistically, whether something was moderately positively correlated, strongly positively correlated, weakly negatively correlated. So if two stocks move in the opposite direction of their returns, they're perfectly negatively correlated. If most stocks move positively, overall, it's hard to do that, to find negatively correlated stocks. Most move together. But the idea in the theory is that if I can combine different combinations of stocks in my portfolio that move in opposite directions of each other, I can still maintain return but reduce the risk. And that's one of the things we want to try to do. That's what a lot of portfolio managers, mutual fund managers will use a lot of mathematics, quantitative analysis to try to reduce that overall risk. So you're going to do a little bit of review about the idea of the capital asset pricing model, the idea of the risk-free rate, plus the beta times the difference between the market return and a risk-free rate, for the specific companies. Again, that idea of beta, to explain that, and I encourage you to look up the betas for your companies, but it's looking at past returns of that stock to the market, like the S&P 500. So I want you to think of your stock as the X variable, the independent that's moving all the time, and how did that change relative to the Y variable being the S&P 500. So if you have a beta equal to 1.5 one of your stocks, it says if the market goes up 10%, then your stock returns on average went up 15%. But if the market goes down 10%, then your stocks would go down an average of 15%. So obviously higher betas mean that there's more volatility and more risk. It doesn't necessarily mean a bad or good thing. It just shows that there's wider fluctuations in the return to the market. If you had a beta of equal to 0.5, it'd say, hey, if the market goes up 10%, your stock went up 5%. If the market went down 10%, your stock went down 5%. So there's less volatility in the overall market. So lastly, in that chapter, you can read about the efficient market hypothesis. Harold Markowitz came up with the idea in the 50s, kind of one of the classic rock stars of finance. But essentially, he was saying that if you look at all the potential possible returns of different portfolios to put together, you can come up with this efficient portfolio return. You would always have certain combinations that would dominate preference over the others, and that's where that line comes up, kind of that little umbrella shape. But you're going to look at indifference curves, and that goes back to economics, the idea of utility. You're always trying to get to a higher level utility on an indifference curve. So you're going to select a combination of stocks in a portfolio that gives you your highest level utility given your risk preferences. And and again, the idea of trying to reduce that overall risk. So all right, last with chapter 6, kind of a lot of the appeal of the common stocks. One of the things that, I'll probably talk about later when we get to mutual funds, but I watch a lot of the YouTube stuff at night. I was watching a thing from 2013 documentary. It was interesting. Even in this chapter, they talked about the fees associated with mutual funds and how they've gone down. But if you, as an aside, you get an opportunity, just take $100,000 and do a future value problem of 50 years. If you had invested that at 7% and had vested at 5%, and think of that as like being a mutual fund fee of 2%, you'll start to see how quickly those fees can eat away at your returns. And that's what a lot of criticism back in the market when I was watching this PBS Frontline late at night. But the good thing that authors talk about is some of those fees have been reduced. They were mentioning that in this chapter. But you as investors, we'll talk about this more as mutual funds, you really got to understand those fees of those mutual funds. Yes, you're paying people to manage those funds, but those fees can really eat away at your returns, especially for retirement in the long run. So that's where you really need to understand those. Okay, so you're going to learn more about dividends. Like I gave an example, posted out some dividends. There's like sites that I like to go to that has like NASDAQ historical, the idea of like the declaration date, the ex-dividend date, so they can identify in the back office who actually owns this stock, date of record, which ex-dividend happens before the date of record, and the actual payment date. So I own Evergy stock and in one of my IRA portfolios, so they pay a dividend of like 53 cents a share. It's currently trading a little over $60 right now. It has a dividend yield of probably 3.3%. But in terms of that, you can look all that information up and see how much it pays out in a particular dividend. So, and then what I have, like at Fidelity, I just have it set up that every time I get a dividend from Evergy, I just buy more shares of Evergy stock. So that's what they talk about, a dividend reinvestment plan. Payout ratio is kind of a term back from finance. I like to think of it as a soup. I always use that analogy with you all, and they think of the soup as the profits. But of those profits, they can decide to pay out maybe 30% of that in the form of a dividend. And managers of the company are very cautious about increasing dividends quickly. They want to make sure they can continue that dividend or have it a slight increase each year, which has kind of been the case with Evergy the past 5 years. They've slowly increased the dividend just a little bit. And then you're going to look at the types of stocks, the different ones from blue chip to income to growth. Tech, I like to think of the FANG, the Facebook, the Amazon, the Netflix, the Google. Speculative, cyclical, defensive, and market capitalization stocks, small cap, mid cap, large cap. Small cap, anything of total value of outstanding shares less than 2 billion, between 2 and 10, mid cap, and larger than 10 billion, large cap stocks. And then last, you can read a little bit about the strategies, the buy and hold, income, long-term growth, aggressive management. So, just different things that we'll read more about, probably get the mutual funds, but also, strategies you could potentially take on. But again, it all goes back to your risk tolerance. But for most of us, as I said in the beginning, we are risk adverse. We want to try to reduce that risk, and we could do that by selecting assets or securities in our portfolio that are not so positively correlated. So the closer you get to a negative correlation, a -1, we know that's not realistic. Um, Even the textbook authors are talking about, different periods of time. Your readings you'll go through this week about, 2009, that even stocks moved more positively correlated in those time periods. They moved poorly. They went down in the directions, but you couldn't diversify away all that risk. And just to wrap it up with this, back to the CAPM model and William Sharp, you'll see a graph in the textbook that kind of talks about that it used to be this idea of 20 stocks, and now that really doesn't really hold, but the idea that you could have 20 stocks in the portfolio that were not correlated with each other. And I put a little thing out there from William Sharp you can watch again, is you could diversify away most of that company specific risk. But there's always going to be systemic risk in the market that you can't diversify away. But still, as managing your assets, you want to try to reduce that overall company-specific risk. You don't have to. You can gamble. You can just invest in like one stock and hope it does very well. If you had bought Microsoft or Apple years ago, you'd be on a beach with a frou-frou drink. But you could also be in the poorhouse. So it's why it's better to diversify. So hope everybody has a great week. And if you have any questions, do email me. But I'll jump in those forum discussions. And good job with that. Just keep it up. Take care.